Welcome to the Legacy Lounge, Jeff.
Thank you for having me. It's good
It's
to
our
be here.
pleasure. Today we're talking with you, partner at Carnrite Ventures. We're really excited, particularly because the interest in private investments and venture capital in particular has really grown. And I want to touch upon that why a little bit later. But can you tell us a little bit about your background and what led you to Carnrite Ventures?
Sure thing. Well, thank you for having me, first and foremost. I'm excited to be here. So Carnrite Ventures was really organically formed kind of over 10 years ago as the investment platform for the Carnrite Group and its principals, its consulting partners. The Carnrite Group was founded by my dad, over 25 years ago. It's had a bit of a different shape and form over the years, and now it sits within Alvarez and Marsal as well. But historically, that group has been a core group of consultants and operators who have worked with energy and industrial companies, big and small, kind of the full spectrum of company sizes. They've done corporate strategy, M&A, performance improvement, really any issue that a large or small energy company has. The Carnrite Group has worked to partner with them over the years to accomplish that. And then over 10 years ago, they started finding these interesting investment opportunities, whether they were in the private equity world or they were more active, where they actually went in and helped run the company. Like they had some experience, almost playing interim management in some of these turnaround opportunities, to venture investing, to real estate, to private equity. That platform, by the time I joined, probably had 25 to 30 different investments in it already. And that set us up for some pretty good success kind of with that infrastructure.
And I want to hear more about your background, but I would like to add right here. It's just been a pleasure. I've worked with your dad going back that many years. And now to see you in the company and in the industry that he started, and a father-son, and of course, we're a mother-daughter team
Yes.
here at Stavis Wealth. It's really enjoyable to be able to work with people that I value and trust so profoundly. And so it's fun to have the next generation here today.
Absolutely. Yeah. It's been a fun experience. I joined our company in 2020, just before COVID. I started my career, I've always spent my career in the finance space. So I started my career at a company called Chesapeake Energy, which is now Expand Energy. They're based in Oklahoma City. I basically was in a corporate planning or financial planning role there. I was in an oil and gas kind of trading, marketing role there. And then I went to go work for a different company based here in Houston that was private equity backed. I did more kind of A&D work in the oil and gas space there. Then I moved into investment banking, did that for a couple years, was really interested in capital markets for energy companies and how they think about raising capital and corporate M&A and that kind of thing. And then from there, I moved into my current role. So, my entire career, I've kind of always thought about finance and risk and capital markets and how all these things, fit together. And, at the time, the Carnrite Group team is trying to, basically figure out what to do with Carnrite Ventures and like what is our investment capability, what is our competitive advantage, how do we think about scaling this platform. And then soon after I joined, we decided to raise outside capital for the first time. So up to that point, it had all been, internal capital or partner capital.
Up until about 2020.
Up until 2020, mm-hmm. Yep. And then, I joined, really kind of took a hard look at our investment capability and what we thought we could offer founders, like what makes us different than 1,000 other venture firms, and how can we add value and really differentiate ourselves. So we put a lot of thought into that. And then, the other two partners at Carnrite Ventures, one is my dad, so he's still actively involved, which we really enjoy. And then Michael Aquino is our other partner. Michael and I have known each other for a long, long time. We have similar backgrounds. He started his career at Evercore, did energy investment banking for a number of years, and then went to go work for Carnelian Energy Capital, which is a fairly large kind of energy private equity firm here in town. Michael brings a lot of like the institutionalization of our firm really some good insights there. So he knows kind of how, bigger private equity firms think about doing some of these things and how they underwrite and all that, and has been a great thought partner for
And
us.
he had a front row seat in some of the medical tech sectors that you guys look at, right?
Yes, yeah. So Michael's dad, Dr. Vincent Aquino's very well-known cardiologist here in the Houston area, um, and is an investor and partner of ours, and has been very helpful in helping us think through some of the health tech companies that we've looked at. He's been great with plugging us into his network, not just for diligence but for customer introductions too. So we can't thank him enough for doing that, and I think he enjoys it too. So I don't think he'd mind me telling you that.
You look at so many companies and in identifying what's going to work and what is not going to work. You may invest in companies that start out on one track and then pivot. Can you think of an example there?
For sure. Yeah, it happens very frequently. We have one company in our portfolio that started basically with the vision. They created this amazing AI engine that analyzes rashes or any skin issue that someone has, and they wanted to sell that to dermatology practices. So it was going to be a B2B sales motion. They thought all these dermatologists were going to want this. It makes them more efficient. They can analyze issues quicker, lower cost, etc. They found it was very difficult to sell to dermatologists. Like, not everyone wanted to do more of that kind of work. They wanted to sell, more Botox and, a lot of the things that they really have high margins on. And so what this company decided to do is they pivoted to a direct-to-consumer care delivery model where they themselves are now a virtual first dermatologist. Um, they're scaling very quickly. It looks like the business is doing really well. And at the core of that business is an AI-enabled decision engine, basically, where a patient uploads a photo of their rash or their eczema or whatever, and the AI engine analyzes it very quickly, spits out, what they think the diagnosis is. The dermatologist looks at it. Yep, that's correct. If you have to refer them to an in-person derm, they're able to do that as well. They can fulfill prescriptions at pharmacies and everything. And
That
so
is
that's
such a
one
great.
classic. I mean, part of it was just slower sales cycles with dermatology. Part of it, I think, kind of the incentive model for a lot of derms at the moment is some of the higher margin products. They didn't necessarily
Right.
want to, do a bunch of insurance-backed care delivery and that kind of thing. They're more interested in the cash-only, high-margin
Right.
stuff that they're doing really well on. There's nothing wrong with that. But
Right. But it's a great example of how you can just miss the market by going B2B versus B2C.
for sure.
And there seem to be so many obstructions in the medical space that some new companies can overcome.
Yeah, I mean, we think it's one. They're scaling very quickly. I mean, the business is doing really well since they pivoted to a D2C motion. We invested kind of right around when they made that pivot, and so
Great.
we thought that was a great kind of inflection point, and thought the business made a lot of sense. I think at some point they can still partner with some of these other channel partners, whether they're large dermatologists who don't want to do that kind of work, and so they end up referring patients to our portfolio company, and or even large, kind of more generic, medicine companies like Hims and Hers or Ro, or people who have dipped their toe into the skincare space, but it's all generic meds, right? They don't really want to do anything insurance based where they have to get involved with payers and that kind of thing. I think if they wanted to get into that space, it'd be a great partnership opportunity.
So following these companies allows you and them to look at different avenues.
For
It
sure.
might be a different journey than they thought originally, but still successful.
Yes, and it is a fine line. Like, you look for founder persistency and grit and like the ability to, be told no like 99 times and maybe on the 100th time you get told yes, right? So it's a fine line between like banging your head against the wall, for some of those very challenging
Great
things,
point.
and pivoting, right? Like, you kind of have to know when to make that switch and not just pivot for like the sake of pivoting,
Right.
but pivoting in such a way to where it makes sense. And again, maybe you end up coming back to that B2B motion at some point, once you have scale and you've shown that you can do this with a lot of patience and that kind of thing. So it's tricky for sure.
So, with more than a decade under your belt now, you've seen a lot of things and you're diversifying among some of these sectors. Um, when you talk about early stage, for those who aren't as familiar with VC, can you talk about early stage and how that might fit into the whole spectrum?
Sure. Yeah. So I think about venture um, really as an industry. It's a couple different asset classes in my view. So you have later stage venture, which is like large Series C, Series D, Series E rounds, almost like growth equity rounds. I mean, these are massive companies, very large private companies raising hundreds of millions of dollars, if not billions of dollars, which we'll
Now,
talk about. How large some of these private companies are getting
and we're starting to hear
and why they're
trillions all the
right
time now.
and why they're not going public, which we'll get into.
Yeah.
Um, and then at the other end of that spectrum, there's early stage venture, which is like pre-seed, seed, Series A funding, which is more what we do. These are companies that are just getting started. They have a team, they have an idea that they want to go execute on paper. They might go raise, $1 to $5 million, kind of to go get them started. They're iterating on product. They're trying to find product market fit. Sometimes they're trying to find their first customers. And we try to help them do that. So we introduce them to energy companies, to industrial companies, big health systems here in Houston, private practices here in Houston. We try to leverage our network and flywheel here to help companies do
Yeah,
that.
over time, your network has really grown, and I know that that's part of the secret of your success. But if we stand back then, if we're looking at early stage, I guess the earlier, the further it is from going public. But in today's environment, we're seeing fewer companies going public. They're half the stocks that are traded that there were, 20 years ago. And a lot of companies are just choosing not to go public. And for investors, whether they want to invest in private or public, there are just fewer public stocks available to invest in. So, why do you think some of these even larger companies are staying private?
Yeah, I think their calculus has definitely changed, over the last 5 to 10 years even. Um, it's a bit of a circular problem. I think on one side you have, readily available capital funding these very large private companies, right? So you have very large venture firms whose fund sizes have gotten larger and larger over the last, decade. You have large private equity or growth equity funds who are also willing to fund these companies. And then you also have large sovereigns who are willing to fund these companies. And so you look at a company like OpenAI, they've raised billions and billions of dollars as a private company. You look at a company like Stripe, they've raised well over $1 billion and they're staying private as well.
And they could easily cross that threshold from private to public.
Right, that's
but
right.
they choose not to.
And there's kind of one school of investors who are wanting those companies to go public. Like if you were to ask the Stripe founders, I think they would tell you that they're comfortable remaining a private company for a variety of reasons. So that's part of the problem. Like they have this pool of capital that they can go tap in the private markets for the company and for liquidity for the existing investors, for the employees. So they're doing these large secondary rounds where the early investors are cashing out or taking some chips off the table. So that's part of the problem. I think the other part of the problem, because there's fewer companies going public and the ones that are going public are very large, there's this perception that you have to be a huge company to go public these days. Like if you look at a company like Figma, they're IPOing at like a $40 to $50 billion type valuation. These are huge companies. And so I think it's a bit of a misconceived notion that you have to have this huge scale to go public. There's tons of other examples of smaller companies going public and still doing really well. But that's part of the issue. And then I think, for large private companies too, going public is a bit of a trade-off where you have to start worrying about, quarterly reporting cadence and shorter term financial milestones that you have to hit where if, you're introducing a new product.
It's a different regulatory
It's a
environment
very different regulatory
altogether, right?
environment. Whole new different set of disclosures that you have to go, worry about filing quarter to quarter. It is sort of expensive. I mean, doing some of these things, you have to spend legal fees. Obviously, you have to go pay the banks to go IPO. And, you have to worry about, audits and these kinds of things. So I think that's more of an excuse. Like, I don't think that's a good reason for not going public. But if you're worried about, introducing a new part of your business, you're pivoting to AI, you have to go spend, hundreds or billions of dollars to go introduce this new product line, and you're more worried about building that over the next 3 to 5 years, those companies don't have to worry about, quarterly reporting and pleasing investors on a quarter to quarter basis. So I think that's part of the reason, why some of these large private companies might tell you or tell people why they're not going public. And they don't need to. They just don't need to.
The quarterly earnings problem does cause companies to behave in different ways sometimes. And so the combination of regulation and that, but I'm always astounded that we still have 80% of companies in America are private. I think most people think that everything is run, that it's the S&P 500 stocks that are rule the roost. But in fact, we've remained, largely private in terms of American companies. But they weren't always available. These investments, even in private companies, weren't always available to investors. Can you tell me how that has evolved?
Yeah. I think it started, 15, 20 years ago. There was a handful of very successful, technology companies that popped up, like Facebook comes to mind. And everyone has these examples of like these very exciting tech companies that, everyone wanted to get into as an early stage investor. And you can even date back further than that. I mean, think back to, Benchmark funding eBay or Sequoia funding Google, right? There's these like legendary Silicon Valley stories of funding these generational tech companies, right? And so venture capital used to be more like a cottage industry where you had, it really kind of started with semiconductors, where you had this group of folks in Silicon Valley who were largely angel investors that were funding these companies. And then it's really institutionalized more and more over the years. We're not quite where the private equity industry is today or the infra funds are today, but I'd say maybe in 10 years, venture will be kind of in that category where very much institutionalized. You really have to have a differentiator as an investment firm. And, you really have to add value to the companies that you're investing in. Like if you think about a private equity model, you can't just you can't just add value to your investors by financially engineering the business anymore. You have to really be hands-on from a day-to-day operational standpoint to help these companies drive value. Maybe you can get lucky timing market cycles, but I think that's more and more rare these days. So venture, you're totally, there's this bucket of high net worth family offices who have moved more and more into the venture category, partly because they see these amazing success stories, but also there's more and more companies staying private for longer, right? And that value
Absolutely.
is accruing largely to the shareholders in the private sector or in the private market, not to public market investors.
Yeah.
And so by the time the company goes and IPOs, a lot of the value has already accrued to the private shareholders pre-IPO. It's not always the case. Like there's still a handful of companies that end up 5xing or 10xing after they IPO, but a lot of the value is being generated.
When you talk
in
about
the
a
private
5
market.
or a 10x, I just want to help our audience. It's pretty logical, but what you're saying is that for every dollar you put in, you're returning 5 or 10.
Yeah.
Okay. And you talk about small, we know there's medium, we know that there are now very large companies that might have in days of old gone public. What is the space, when you define small, what would be the size of a smaller fund versus a mid or a large fund?
Yeah, it's a huge range. So at the small end, you have funds that are as little as $5 to $10 million. We think about those like funds like our size. The high end of our spectrum, like I think our fund strategy works kind of up to 50 million and smaller.
Okay.
And so we would call those essentially micro funds. I mean, these are very small seed funds that are investing in 20 to 25 companies from that fund.
So that's your space.
That's our space.
And maybe it could up to 100 million or something like that. But you've often said that size is your advantage. Can you speak to that?
Yeah, we like to tell people like fund size is your strategy. And so, we think again our sweet spot is kind of 50 million and smaller per fund vehicle. Um, we think if you get much bigger than 100 million, it really challenges a lot of the venture math. It's just from purely like a law of large numbers, it's a lot harder to return 4 to 5x on like a $500 million fund or $1 billion fund than it is on a $25 million fund. You just need more ownership per company that ends up exiting and doing really well, right? So think of
And you're very involved. One of your, one of your standout qualities is that you become very involved with these companies, even the networking that you do with them. But can you speak to the kind of mentoring and counsel you give the companies that you invest in?
Yeah, so we invest, per fund in probably 20 to 25 companies. We'll end up investing in a seed or Series A round, and say the company might be raising $10 million or $15 million as part of their funding round. We invest, anywhere from $100,000 up to $1 million per entry check. Is kind of how we think about it.
So it could be more later.
It could be
But
more later.
the portfolio companies that you have could be anywhere from just 100 to a million
Right.
going in.
Going in.
Okay.
And then we size each investment as if, over the investment period of our fund life, as if each company will have equal ownership, right? So if it's an earlier stage company that's raising a pre-seed or seed round, we'll do a smaller check. If it's a Series A or Series B round, we'll do a larger check, right?
That makes
Because we know
sense.
more about the company, it's more de-risked. And then as the pre-seed or seed company raises more follow-on capital, we'll add to that company over time as long as they're doing well. Of course, they don't all perform equally, right? So you have some in the portfolio that end up, you have a higher allocation to. You have some in your fund that you have a lower allocation to just based on performance and how that company's
But
de-risking.
it's not like you're placing the money and walking away. You stay very involved with these companies, and
Yeah.
that you have certain expectations for them going in, and then you're monitoring it on a regular basis. There must be so many companies that want money. So can you tell me a little bit about how you identify a company and your due diligence process up front in putting something into your portfolio?
Sure. Yeah, so we look at companies all over the U.S., coast to coast. I mean, I think we try our best to keep track of this, but we probably look at, 1,200 to 1,500 companies per year, roughly. It's a big number. These are companies, that we find through accelerator programs or through universities or through other investors that we know, cold inbounds. We do quite a bit of outbound, outreach as well. We'll find a company or 2 or 3 companies that are operating in a sector that we find really interesting, and we'll go and reach out to, 2 or 3 of these guys, try to stay in touch with them for sometimes up to a year, maybe even more than that,
Okay.
before we end up making an investment. And so,
And how do you find them? Like needles in a haystack with the number of small companies, but how do you
yeah,
do that?
I think probably 90% or so of the companies that we actually end up partnering with are, we have some kind of proprietary access to. So that's either a founder that we know who's spinning up another company. It's another,
Okay.
we know one of the co-investors or board members who's introducing us to this business. Or, we're finding them somehow through our network. We've had a couple examples of, LPs of ours who end up, finding this company, and then, they end up sending it to us to take a look at.
Since there's not a lot of public information on these companies, you really have to go deep. And I know you've got some affiliations and you've worked with universities. Can you talk about universities in particular and how they bring innovation into VC?
Sure. Yeah. So we, well, first and foremost, I mean, we have, 40 to 50 limited partners that are invested in our funds. And so I'd say probably 80 to 90% of those folks are high net worths in the Houston area. And so we have this, breadth of individuals that we lean on for diligence and for customer introductions. Like you asked earlier, how do we add value to the companies that we invest in? That's a huge part of it. I mean, we think there's a pretty big network effect with the folks that are partnered with us. Even if they're not invested in our funds, we know other investors and we know other, thought partners that we can bounce ideas off of and that kind of thing. And so, I think part of our secret sauce is, almost unlocking these Houston relationships for a lot of the companies that we're finding, usually not in Houston or not in Texas. And so sometimes we're the only Texas investor for a company that we invest in. And because we're not taking up a big part of the funding round, we're able to get into very competitive deals really on either coast for that reason. So like a founder will look at our fund and the value prop really resonates with them because we're not taking a board seat usually, or we're not eating up a big part of the funding round. We're still very active and we're helping them with customer introductions and with fundraising and that kind of thing.
And I think you mentioned that Texas has become a very interesting place for people to think about and talk about, and it being the nexus of energy and space and medicine. I think sometimes we overlook how diverse we are. And tell me about the interest that you've had from people that look to Texas.
For sure. Yeah. I mean, Houston has a lot to offer. Houston does and Texas does, obviously. I think people are looking at Texas now culturally as this like builders state where you can come and build your business. There's folks who are cutting a lot of the red tape for a lot of these founders. You can move more quickly. You can build stuff faster. And so I think Texas is kind of having its like cultural moment.
A land of opportunity.
Yeah, a land of opportunity for sure. I mean, you're seeing a lot of, semi projects get built here. You're seeing a lot of data centers get built here for that reason. It's just easier to get things done and you can do it much quicker. Houston specifically is kind of a bit of a dark horse. I mean, there's a lot of very large companies here who are potential customers for a lot of the companies that we invest in. There's very large health systems here, obviously. We have the world's largest medical center in the TMC. And we think there's this, on the life sciences side, there's a bit of a mismatch between, a lot of the world-class health systems we have, and there's not enough biotech companies being built here. And so you asked about Rice or some of the university partnerships that we think about and some of the partnerships that we form. We partnered with Rice on it's a for-profit venture studio that they've incubated kind of within the university.
When did that begin?
So we've had a good relationship with Rice for a number of years, and they're pretty active here in Houston with a handful of events that they do, and they have an energy tech venture day that they do. They have a big business plan competition that they do for students, and so there's all these companies that end up getting founded from these Rice students, which
and
is
you
really
attend a
interesting.
lot of those.
Yeah, we go to all of them. Yeah, so it's they also do a great life sciences day that we go to. It's actually coming up here in a couple weeks. And so Rice does its part. I mean, Rice does quite a bit.
And the medical center is across the street.
Yes.
So there just seems to be a lot humming.
Yeah. And we found out about this venture studio back in the spring and thought it was really interesting. As far as based on our research, we didn't find any other university who's done something like this. Usually a university will have, their tech transfer office where they end up licensing IP to some team, and then they own a piece of that new business as part of the tech transfer, so they kind of drop the IP into this business. What Rice decided to do was, hey, why don't we just set up this for-profit venture studio? Rice will end up owning a big piece of that, and then it's us and one other venture firm who are the two other investors in that vehicle. And then they're going to stand up 2 or 3 new businesses per year that's taking the best biotech IP from Rice and from the TMC, and they're putting a team around it. They have office space, they have lab space. They're based in Helix Park, and they'll write a check into this business to help get this biotech idea off the ground, put a team around it, try to bridge that gap between really interesting biotech IP that's just kind of sitting there on the shelf, ready for someone to come put a team around it. There's so many examples of that in Houston.
Incredible.
And Rice is trying to bridge that gap
And because
firsthand.
because of your relationship and because you've been interested in everything they've been doing, it's very much a part of your network now. And as so many things are, and it's really a business based on relationships and trust, isn't it?
For sure. Yeah, I tell people this all the time, but it is very much a people business, like so many things in the investment world and the finance world. We look for, one of your questions earlier was like, how do we find these companies, and how do we think about diligence and making the investment decision to partner with these founders? More than 50% of that equation is the founder. I mean, it's more art than
Really?
science for sure at the stage that
Okay.
we invest in, because oftentimes we're investing in companies that have little to no revenue, and so you're kind of making a bet on the founder and their experience within this marketplace, where they think
And
the
their
market is
management
going.
team,
Yeah, they're
possibly, and it may be very small to begin with, but
yeah, um, and when you think about the founder, you're also thinking about, can they attract talent? Can they attract capital? What's their secret about this market that no one else knows, and their view on where they think this market is going.
a differentiation. So
For
that's
sure.
one of the things you're really looking for.
That's like more than 50% of the
Okay.
equation for companies that we
Okay.
invest in.
So once you've identified a company that you think, could really excel, how much do you decide to invest in each company in your portfolio if you've got 20 or more companies?
Yeah. So if a fund is, call it $25 million for one vehicle, we'll probably invest, well, initially anywhere from $100,000 to $1 million kind of per company, per check, right? So if it's like a later stage business that's a Series B, we might do, a much larger check, because that company might already have, $15 million of revenue, and it looks like they're doing really well. They have line of sight
They're
to,
more mature in their revenue
yeah, they're just
cycle.
more de-risked. So we feel comfortable, investing a larger amount
Okay.
into that business, usually at a higher valuation too, right? Because the company is doing much better, and
Right.
it's more de-risked. For a pre-seed company, for instance, we might do as little as 100,000 or 200,000 or 300,000, because it's very, very early. There might be some technology risk involved. There's certainly team risk involved, right? We have to see that they can go from 0 to 1, and put these kind of proof points together before we end up adding more to our position over time, with the expectation that that company still might have an equal fund allocation as the Series B company, right? So over time, we still might get to the same end point of total dollars invested per company, just in different stages.
Okay. And so once you've made the investment, you're monitoring them and you have expectations of them.
Yep.
And so what is the structure that you have in place there?
Yeah, most of the time, I mean, usually our touch points per company are pretty frequent. I mean, I'd say per month usually is how often we check in with
Okay.
companies, maybe once every other month. Usually we do not serve a formal governance role, and so we're not on the board. And sometimes we'll be a board observer, where we get to attend the meetings and we get good insights into the company and how they're doing. But usually we don't hold a board seat. And so we
Is
like
that
to
by
think of
choice?
ourselves, it is a bit by choice. Like if a company was to ask us to serve on a board, we'd be more than happy to serve a governance role. And sometimes that has happened. But we think we can add as much value to the companies that we invest in without a governance role. And founders tell us all the time, actually, that we're some of the most helpful investors on their entire cap table, and we're one of the smaller investors. Part of the reason for that is you have larger funds investing earlier and earlier. So you might have a big fund, I won't mention any names, but a big fund who's investing in a seed round. The company might be raising $5 million, and that fund size might be $3 billion, right? So they're just looking for option value in these early stage companies. They're not really going to be that helpful. They'll write a $2 million check into the business and just try to sit back, see how the company does over the next couple of years before they decide to
And the
really double
larger
down.
it becomes, the harder it is to capture the right price, because by the time it gets close to mature or even IPO, most of the money's been made along the way. Isn't
Yeah.
that fair?
Yeah. I think that's definitely true. I mean, you saw some periods of time where there was, back in like 2021 where there were so many companies that were exiting. You saw some of the later stage funds try to capture that arbitrage where they were the crossover funds who were investing in a late stage private company, hoping that the business would IPO in like the next year, 18 months or SPAC. They were trying to capture that arbitrage. It's very rare to be able to do that successfully and continuously over time.
In fact, some open and drop precipitously.
For
after.
sure.
Yeah.
Yeah.
We've seen that too. Interesting.
And so, yeah, I mean, our goal, like in partnering, with founders that we invest in, we invest very early, and then the most value that we can add with companies is with customer introductions. And so we invest in really 3 verticals: energy tech, industrial tech, healthcare tech. All have pretty long sales cycles. And so if we can help companies speed up those sales cycles by getting, their foot in the door with a large energy customer, whether it's oil and gas or utility or something, or a health system or private practice, that's what we try to do. Or it could be a channel partner, right, where they end up partnering with this company who might have 100 or 150 healthcare companies that they're working with. It could be a billing business or an admin business, and then it could be a great channel
So you're
partner
just leveraging
for them
their
to
success.
sell. Right. So they partner with them, and then they get access to like 100
Great.
or 150 companies. So
So I'm going to ask you 2 questions. One is, give me an example of a company, it doesn't even need to be my name, but that's been a really huge success. And maybe it even pivoted along the way from, something that you bought and pivoted and changed, but was extremely successful. And then no one bats 1,000 in this industry. So if we can talk about that also in terms of what that adventure is like
Sure.
in selecting companies.
Yeah, I mean, we've had a couple companies. I'll give you, probably one of the most successful companies that we've invested in recently is a company called Colossal Biosciences that I know you guys are familiar with. But
Fascinating.
their initial mission was to de-extinct the woolly mammoth. We kind of always viewed it as a platform business that had all these other biotech and life sciences applications that were going to either spin out of the company over time or was just going to be this amazing kind of platform business where all that was going to be, available to customers over time, whether those customers were governments or life sciences companies or what have you.
And when you say information, you're talking about health data banks, right? Health information.
Yeah, so they have an amazing
DNA,
sort of
actually.
biobank of animal species DNA and data that they've assembled.
Okay.
It's really quite remarkable. And the team that they put together, too, is just kind of world class. And there hasn't really been an effort like this in the past that has assembled such a team and the amount of capital to go after some of these problems. So it's really kind of never been tried before, which is what's so exciting about the business. But even though they're focused on animal species, we think there's all kinds of other applications for humans. And so it's going to be this business that, is, I think, going to end up having several different kind of revenue line items that is going to be really, really exciting.
So it really started out being more preventing extinction of existing animals, or maybe even bringing back some species, and it's turned into something that is much bigger.
Right. Yeah. Yeah. I think when we invested, it was back end of 2021. I think we invested in the Series A round, and I think the valuation at the time was in the hundreds of millions of dollars, and now it's worth over $10 billion. So it's they've raised quite a bit of capital, and the business is doing really well.
I think that's what they call a unicorn.
Yes,
right?
And I think they claimed at the time that it's one of the only decacorns that's ever been founded in Texas, a company worth $10 billion or more.
Wow.
So, and it's still very early, which is kind of the exciting part. Like they're still kind of very early in their journey, and I think it could be worth multiples of that at some point in the future.
You're doing something really interesting with respect to energy in the West Coast. Can you speak to that a little bit?
Yeah, we invested in a business well, two different companies that they're both, they both have teams in the LA area, and that's where a lot of their initial customers are. One of them is a company called Haven Energy, which is the one you might be referring to. They basically partner with utility companies to get residential batteries deployed to homeowners. The utility company is interested in that for demand response because they have 30 or 40 days of peak demand per year where they want to partner with these virtual power plants to have the batteries discharge back to the grid when the grid is stressed on the 30 or 45 days of peak demand in the summertime. They're largely focused on California at the moment, but they're expanding to other states here pretty soon. I would say early 2026. That one's very exciting. We knew the founder for a couple years, and we actually ended up reconnecting with him earlier this year when he decided to raise mostly an insider round. We were one of the few kind of net new investors.
Great opportunity. And I
Investing
think
in
just
that.
given what you've been doing in energy for a long time, what we're seeing obviously is Texas becoming more interesting because of the unfathomable amount of energy needed for AI. And so you're probably reaching out to many other communities outside of Texas now.
For sure. Yeah.
Yeah.
I mean, if you look regionally, like where a lot of these data center projects are being built, you're already starting to see some ripples of customers complaining about their utility bills going up as part of these new rate cycles.
Definitely.
And so it's a huge issue. Residential batteries are some of the quickest way to get storage assets deployed. And so, utility companies love it because they're able to get, storage deployed way faster than they otherwise would be. So it's kind of a win-win-win.
Partnership.
Yeah, it's a win for the company. It's a win for the homeowner because they get this, almost free battery system. And it's a
Right.
win for the utility company.
Terrific.
That's one company that we invested in earlier this year. We've known the business for several years. So it was an easier process for us to diligence once they circled back with us. Another company that...
And obviously, I just want to be clear about the fact that these are for accredited investors. And I didn't make that point earlier, so it's fair to say that but they have loosened a lot of the accredited rules and it's much more accessible, but that's the bottom line. There must be examples of companies that did not meet expectations. And what was that experience? And then how do you cut loose?
Yeah, it's a, kind of the historical split in any venture fund has been, kind of roughly a third of the portfolio end up doing really well. You end up earning 10 to 15x. This is for a seed stage fund, but you end up, earning 10 or 15x on, call it a third of your portfolio, right? So these are massive, really successful outcomes. The middle third, you might end up making a 1x or 2x or something. So you might get your money back or single or double. And then the other third goes to zero. And so it's just kind of a, forever that's kind of been the standard in venture, like within any portfolio, that's what expectations are. And in aggregate, like what we think that kind of shakes out to at the fund level is a 4 to 6x net return. These are after fees is kind of what our experience has been historically. And that's what our goal and expectation is per vehicle that we set up. So the third of companies that end up, don't making it, for whatever reason, usually it's because the founder they might have even had the right idea, like the right market that they were going after, the right idea, looked great on paper. If you were to go back and ask us, like, would we invest in it again? We might even tell you yes, but probably with a different founder. And so, they weren't able
Or a different team.
Yeah, with a different team. They weren't able to execute for whatever reason. They weren't able to get, scale and distribution into their customers for whatever reason. Or they weren't able to attract capital, right? They weren't a storyteller who were able, to go convince other investors to invest in their business. And so that's usually it. I mean, if we think back, the ones that haven't worked for us, it's almost always that case.
Okay.
Like right market, it might have even been the right time, just not, lacking on the execution side.
I think the way you discuss the one third is so valuable because that's what investors should expect. I mean, they have to expect that some of the companies may not go the distance at all. Some will be maybe even walking wounded. They continue, but they're just not the flyer. And then you're looking for some of those jewels, and that's the way the industry works.
Yeah,
But the
it's
deeper your network, the deeper your team having deep knowledge in energy and medicine. Your leadership team has a lot of expertise in all three of those areas.
yeah,
Space,
it's
even you've done some interesting work with companies, space sector.
yeah, it's really, when you explain it to people who aren't familiar with venture, they kind of look at you like you're crazy. They're like, well, how do you know, split your portfolio? And, how do you have that expectation that like maybe half your portfolio is like a 0 or 1x? It sounds crazy on paper, like explaining that to people, but the way that we think about each company, say we invest in 25 companies within any given fund or within any given fund vehicle. Each company, we try to think about like the upside case. Like we do kind of a very thorough scenario planning analysis where we think about, okay, what are the 5 or 6 things that could happen with this business, and what does that mean from a financial return perspective, and like what are the core truths that have to be right for this business to end up doing really well. And so that's kind of how we think about underwriting it. You're almost peeling back the onion as you're thinking about, okay, for this to be a 2x, what must happen? For this to be a 5x, what must happen? For it to be a 10x, for it to be a 30x,
And
what
that's
must
that constant
happen?
observing that you're doing.
We do that with every
Yep,
company. Yep.
with every
So,
company.
um,
And it's a law of averages. It's math.
yep. And so for that upside case, like if everything goes right and, we end up, business ends up doing really well, that upside case usually has to return close to the entire fund. It's kind of how we think about it. And so if we're investing $1 million in one business, that would have to be, a 30x to return, 25 or $30 million fund, right? So that's kind of how we think about it. Like that upside case has to be substantial enough to meaningfully return the fund, or very close to it. Like if it's 75% of the fund or
Very
something,
helpful.
that's okay.
Now, since venture capital has become it's becoming more democratized, it's very interesting. There are also public funds that are available with VC. How would you characterize the differences between those funds and the smaller funds?
Yeah, I would almost consider those kinds of vehicles similarly to how I was discussing the large kind of growth equity, like a very large venture fund that might be $2 billion or something, right? It's almost a different asset class within the same industry. Like with I look at venture capital kind of as an industry at this point, with a few different asset classes in it. That asset class is at kind of the large scale, lower return, lower risk standpoint, or actually some of it might even be a similar amount of risk but lower return, right? So there's a bit of an asymmetry there, I think. But their expectation might be, 1.5 to 2x type return, and then at the where we operate at the seed stage is more like a 4, 5, 6, 7x type kind of net
Okay.
goal that we're seeking per
More
fund.
risk because it's early stage, but more
More risk,
potential
more return.
upside return.
Yeah.
Yeah,
But it's
great.
almost two different asset classes where, whether it's a public or semi-public vehicle or just a very large kind of growth equity or late stage venture vehicle, their return expectation is just totally different from what ours is. And so it's okay to invest in both, right? Just understand kind of what the goal and expectation is for each of those.
Well, and because it's a long game, it's hard sometimes for investors to understand how to know how their investment is doing. Can you speak to some of the standardization that's happening, some of the benchmarks that investors can use to get some idea?
Yeah. So on a quarterly basis, I mean, we do this, but from a reporting standpoint, we'll send out quarterly investor letters and kind of a full mark to market for all of our companies. And so usually if it's a very early stage business, what that means is we normally end up holding a company on our books until they raise a subsequent funding round. And then we'll price that company at whatever the last funding round was, right? There's a handful of companies that are now more mature in our portfolio that are doing really well. We have one company that's grown 25x, and they haven't raised capital since when we invested. And so that one we have marked up kind of internally as we think about what that business might be worth, just because they've grown within cash flow, to such a scale. So there's some nuance for some of those types of companies.
But there are performance rankings that put VC in a top decile or a top quartile. Can you speak to those benchmarks?
Yes. So some of the fund data that people look at is all on a net basis. This is after fees actually to the LP. Net TVPI, which is total value to paid in capital. That's like your multiple on a business that you haven't exited yet. And then there's net DPI, which is what you've actually distributed from your fund back to investors. And so, your
and net, you have to be in the distribution phase for that one to come into play, which is usually later.
Correct.
Stage.
Yep. And then there's net IRR, obviously, which kind of looks at, on paper, what has the fund done? And then how do I think about that versus like the S&P and that kind of thing. From a private market standpoint, like if you look at the universe of alternative assets, the top quartile venture funds have historically outperformed every other private asset class. So that's my pitch. Like when people are like, man, why should we invest in venture? It takes a long time to get liquidity. The multiples look average. That's if you look at like the mean or median venture fund, that is very true. Like the dispersion between, or the gap between a top quartile venture fund and a bottom quartile venture fund is enormous. And the gap between a top quartile venture fund and even like a mean or median venture fund is also very large. And so manager selection is critical. Like you want to partner with fund managers that have some kind of differentiated strategy. They think they can return, 4 to 5 to 6x kind of net, I think is what that top quartile venture fund manager needs to target in order to hit that kind of top quartile performance.
But let me repeat back to you what I think I understand, and that is that you're investing in a portfolio of companies, and then at periodic points, they're looking at the original value that you invested in the company and then looking at the value that company or group of companies have gone up.
Yep.
And there are third-party services that confirm that, right?
Yeah, a lot of it's self-reported. We tend to use PitchBook, who's like the biggest aggregator of private markets data.
Okay.
We benchmark ourselves against all the PitchBook fund data that is out there, and they post this quarterly. And so they post, all the metrics that I just discussed. And then we look at our funds and how they're comparing against the PitchBook funds of an equal fund vintage. And so if our fund was raised in 2023, if our fund was raised in 2020 or 2021, we compare, similar fund vintages to make sure that we're comparing apples to apples. But I think PitchBook has, 50 to 100 funds or something like that LPs report their performance data to them. So it's all after fee, on an after fee basis. And then, thankfully our funds have performed kind of consistently in the really beyond top quartile. So, most of our performance has been closer to the, top decile type performance.
Well, and like any performance reporting, the more time and the more investors involved, the more mature this will become. But right now, a lot of people look at S&P and it's apples and oranges, and there really aren't quite as efficient indices. But I expect they'll evolve over time, don't you?
Yeah, I think so.
It's much harder.
Yeah, well, because a lot of it does have to be self-reported, right? You kind of have to opt into it. Another one we look at is the Cambridge Associates. They're a big fund of funds. They post this data too, not just for venture, but for private equity, for real estate. PitchBook does this as well. So we look not just within venture, we also look at, our venture fund performance versus other private assets, whether it's real estate or private equity or whatever, to make sure that we're kind of within that bound that we would expect to be, right? Like we know kind of what we're shooting for. And then, comparing it, private to public, like I think the public markets trade more on liquidity and sentiment and not necessarily on, kind of long-term fundamentals, kind of back to what we talked about for, quarterly earnings pressure and these kinds of things.
Right.
private markets, it could be a feature, it could be a bug, but for the most part, they're building for long-term value creation. And so we saw this, back in 2022 when the public markets dropped, when the Fed started hiking rates. Our part of the venture market was pretty resilient. Like, you didn't see that much change in the early stage part of the market. You actually saw more folks wanting to invest in that area because they thought it was more insulated from public market pressures,
And
right?
it comes down to that non-correlation, right? The fact that venture capital just behaves differently.
Yeah.
And the milestones are not those quarterly earnings, but it's just as careful in terms of looking at how that company's grown in value, whether it's continuing to be managed well, and so they're monitored, but just not using the same yardstick
Yeah.
that the S&P does.
It's totally a different, like, we might invest in a pre-seed or seed company, and within their first 12 months, they might have only a couple major updates. If it's like a deep tech business or biotech business where they're really working on some big technical inflection point, it wouldn't even really make sense to have quarterly updates for that business, because like if we're sending out an update to our investors, it's like, well, this company looks like it's kind of in the same spot as last month because they're doing a ton of work in the lab or what have you, and it just might take 12 or 16 months to get the product to a point where it's ready for pilot customers.
And so,
And so that time
investors
period
have,
is just totally different.
and investors have to understand that illiquidity about it. That
Yeah.
you can't. You've got to play the long game. You can't be looking at getting your money back in 2 or 3 years. You're
Yeah.
going to have to wait and go the distance to get the higher returns.
Yep. Yeah, I would definitely say probably, I mean, the data now, as you know, I mean, companies are staying private for longer and longer, like Stripe and SpaceX. Some of the biggest private companies have been private for like 15 years. Doesn't mean that you can't generate liquidity within that time span, right? Via secondary sales or whatever. But
And you take advantage of those as well, I know.
we do. Yeah, we look at that. Like, we had a company that we sold 100% of in 2021 when the market was really frothy, and we had another investor come to us who was interested in adding to their position. On paper, I think we were marked up, 16 or 18x or something like that. So we ended up selling 100% of that position to another investor, and we're happy. We were happy to do that.
So there can be liquidity along the way, but it's a lot chunkier.
For sure. Yeah, we kind of, per company, I mean, the way we think about the holding period is almost like a 5 to 10 year holding period.
Okay.
Each of our funds, kind of the standard in venture, is a 10-year fund life. We try to monetize most of it prior to that point, but you might have, 1 or 2 companies that are still out there somewhere at the end of that 10-year fund life that you have to figure out something to do with. But
Well, what you're doing is so exciting, and I'm so glad you could share something about Carnrite Ventures today. But just a little bit more about you personally. If you had to look back on maybe what was the best advice or the worst advice that you might have gotten along the way, does something resonate with you?
I think some of the best advice I got, probably from 2 different people, but I think my dad always did a good job of instilling in us, to treat people fairly, like regardless of their circumstance. So whether it's someone that, you think might be really important, or someone who's super wealthy, or, it could be like the janitor in your building or something, treat everyone equally and fairly. And that's something that I've always tried to do. Again, it's a people business. Like, how would you want to be treated if you were the founder of a company and you had, a group of investors on your board or whatever? That's something that I try to think about quite a bit. Some other good advice I got, man, a long time ago. This was probably back in high school, but I had a phenomenal art teacher who would always try to get you to look at things a different way. Like, I was a big like wood and metal sculptor. So I would make these 3D pieces, and I would build it one way, and then he would come along and turn it completely and be like, have you thought about, moving it vertically or something? And
Just change the
yeah, just
perspective.
changing the perspective. And that applies to like so many things that I do today. And so It's funny,
It
he might not
really
even remember
does.
that, but yeah, it still resonates with
Because
me
what
quite a
you
bit.
do is a very left brain, right brain. If you're thinking linear, uh, it's probably not VC.
Yeah,
You're not VC bound. You
for
need to be
sure.
so spherical.
You can do all the analytics and look at all the math and the numbers and stuff, and most of it's going to be wrong, like at the stage that we invest in, right? It's probably even wrong at like most larger firms too, or hedge funds or whatever. You can risk it as much as you want to, and it's probably not going to be right anyways within the forecast period. Venture, it could be off like by a matter, factor of 10. And so you're investing in the founder and their ability to pivot if they need to and change things if they need to. And like founder grit and resilience is probably the biggest thing
And
to
things
look
move
for.
fast and change faster than they ever did. So
Yeah.
if you
Yeah.
don't have that, it might not be the best company to invest in.
Yes. And some of the worst advice, that's a harder one. It doesn't,
Maybe you could tune that out.
yeah, it doesn't apply to me as much because, I feel like I had a good college experience, but I feel like our generation was sold this, uh, this idea that like everyone had to go to college to figure out what you wanted to do. And, you end up spending 2 or 3 years before you decide, what major you want to do and that kind of thing. You were sold kind of this college pipe dream. And like when I was in high school,
And that it was like this linear pipeline that if you just make these choices, you're going to
yes.
end up in the right place.
Yeah. And, when I was in high school, it was during the financial crisis. So like everyone, wanted to go to college and no one's even thinking about these other things. And it's like, thankfully I kind of always knew I wanted to be involved in business or in finance. And so, I kind of figured it out maybe sooner than some other folks. But I think just this concept that like you go to college to figure out what you want to do is not a great idea. So
Well, you've already achieved so much at such a young age. You've got a long runway, and that's why we're really excited to be partnering with Carnrite Ventures and having our clients, take a look at opportunities that you bring to us. And I know that authenticity and relationships in this business are really important. You've built your business on that, and we have too. And I just want to thank you for the great information and the genuine approach that you have to business and life.
well, thank you so much for having me. We're excited to partner with you guys as well. And
Be fun.
I really do think it's a differentiated strategy that we have for all the things that we just discussed. And we don't take it lightly. I mean, it is a people business. Like a lot of our capital is invested in this strategy. A lot of our friends and family's capital is invested in this strategy. So we think we're super aligned, and yeah, we don't take it lightly. So it's a people business. So we always put our partners first and try to think about what's best for them.
I always ask this question. Is there a book you would recommend to our target audience? Any favorite book of yours?
Yeah, I thought about this quite a bit. I think there's probably two books that I would recommend. One is more popular than others, but Shoe Dog by Phil Knight is a great book. The Nike founder. It's a perfect story about like founder perseverance and just how hard it is to build a business. If you haven't read it, I highly recommend that. It's a pretty popular business book, but it also just kind of tells Phil Knight's story and like just how many times he got like kicked in the teeth basically trying to build Nike, which at one point was an underdog, believe it or not.
And how we got back on the horse.
Yeah, it's a
The
very good book.
resilience.
Yep.
Yep.
So that one's great, very applicable to a lot of what we do. Think about partnering with founders or even building our own firm, right? It's these are not easy things. Another very good book is called Wanting. It basically talks about mimetic desire and like why people want certain things, and I think it's a good sort of a good eye opener for anyone, but for Americans in particular, like this kind of life of accumulation and I need more. I want a bigger house, I want a bigger car. It really kind of peels back the onion, and it's like, well, why do I want these things? Is it because like someone else has it and like I'm aspiring to be that person? And it really kind of looks into the science of mimetic desire. So
And may even
That's a
help
pretty
one
good one.
clarify their own values
For sure.
and vision.
It
That
definitely
sounds-
helps you
I'll
look,
have to-
it provides a lot of very good examples of that, but it helps you look inward, and it's like, man, why do I want certain things? Like, do I just want that because someone else has it, or do I really want this, and is it actually going to change my life? And helps you think about values that are important to you. So that one's probably more under the radar, but that's a very good book.
Sounds interesting. I'm going to take you up on that one. Thanks so much for being here today. Look forward to working together.
Thank you so much. Yeah, so are we. Thanks.